It is mid-October, and I'm going to start today's webinar by making a very, very bold prediction. Maybe not a prediction about the outcome of the US election or the outlook for the stock market over the next 12 months, but I am going to predict that although today's weather is rather gloomy, we will have more worse days over the next 5 months. Now, having said that, welcome to the huddle for today, October 22nd. My name is Bob Simpson, and I am your host for this series of webinars. Today's focus is going to be on the metrics of financial and wealth planning, and to really begin to answer the question, is financial and wealth planning a good investment? Now, before we begin, I just want to remind you of a couple things, little housekeeping issues. One is that if you go to www.portfoliostewards.ca anytime you wish, you'll see at the bottom, join the huddle if you want to join the huddle as you have done today, or you wish to view some of the previous sessions that we've done, you can do that there. Secondly, at the bottom of your screen, there is the control panel and there's a Q&A button. If you have a question that you would like to ask, simply click the Q&A button. So just to give you some practice, if you want to try, just click the Q&A button and type in, hey Bob, how's the weather? Or what's your outlook for the stock market? Or anything that you want to ask. And that will give you some practice doing that. Now, comprehensive wealth planning is really the holistic process of building and protecting your wealth over your lifetime, generating income during retirement or during periods of life's disruption, or distributing your wealth to your loved ones upon your death. It is a process, the center of which is you and your family, and it's based on your life goals, your needs, your priorities, and indeed on your preferences. It's about planning and identify impediments that may prevent you from attaining your goals and finding solutions to help you to overcome them. Unfortunately, wealth planning was originally designed as a method to distribute products and generate commissions and fees. Now, that's a bit of a sad statement that many people in the industry may not like to hear me say, but I believe in 40-something years in the industry that that's pretty much the truth. Not the way we do it here at Wealth Stewards, but we've really seen the industry over the last few years shift from a commission-based compensation to a fee-based compensation. And as such, wealth planning was introduced really to justify those higher fees and to generate revenue. One of the statements that I often make is that when you speak with most financial planners or wealth managers, that financial planning is a promise, it's not a deliverable. At Wealth Stewards, we'll show you how we actually deliver wealth planning. Now, there is an old cliche that nobody ever plans to fail, but they fail to plan. And especially when you're looking at some of the issues related to wealth planning, things like retirement planning or estate planning, where we may view that that is something that we're planning for that might be 20, 30, 40, 50 years out. We often fail to plan. We don't plan to fail, but we do fail to plan. Now, to engage in an activity, you need to have a driving force before you're really willing to make the investment of time and money to find a solution. A good example of that is we all know people who have had heart attacks, and in many cases that heart attack is a wake-up call. And after the heart attack, you'll find those people suddenly they start to eat better, they start to exercise, they start to pay attention to their health because they had that wake-up call. So, there is, you need to look and you need to decide what is the driving force behind this planning that you plan to do. Now, today our goal is to look at the metrics of wealth planning through the experience of three of our wealth advisors, Nicholas Meyer, Andrew Bryden, and Paul Tyers, by looking at it as an important investment opportunity and to quantify the importance of engaging in wealth planning. So to begin, Nicholas, from a metrics point of view, can you help us to take a look at, why is it important to have a will, Nicholas, is the real question. Is it important? And how can you quantify the difference between not having a will, if you should pass away, and having a will? So I'm going to turn it over to you.
Thank you, Bob. I'll make it as short as possible. I took a relatively basic example, just showing what are the consequences if you make a will. There is a will and the husband dies, leaving all his assets to his wife. So what are the costs and the consequences? So basically you will have the costs of drafting the will and the power of attorneys. You will have also the cost of the probate application. Very important, you have from day one a person who is responsible for the settlement of the estate, the executor, because the will allows you to name an executor. In terms of probate fees, given the fact that the home is owned jointly with right of survivorship, and there is a beneficiary designation for the RSP, the assets subject to probate tax will be relatively limited. In terms of the income tax, that has really a big importance, because if you designate your spouse as your sole beneficiary of your assets, basically there's a spousal rollover and the spouse takes it as is, and the tax consequences are virtually nil. Beneficiaries, well, as you have drafted the will, you have the choice of your beneficiary. So it will be very commonly first your spouse, and once your spouse has deceased, your children. The time of settlement, I've put 12 to 18 months. This is probably relatively a long period of time for the settlement of the estate of the first to die, but it's relatively conservative. Likelihood of litigation, low, because hopefully you have discussed that with your spouse, with your children, and basically you have avoided the potential cost and the hassle, the horrible hassle of an estate litigation. Now, this is what happens if there is no will. There is, first, you don't have anyone who is in charge of settling your estate. So basically you have to prepare file an application. So it means costs, it means hassle because you have to do it as quickly as possible because your assets are frozen, and you have to have the consent of all the beneficiaries according to the local law in Ontario, which means that sometimes perhaps a child might not approve consent to the appointment of a certain person as the administrator. So immediately that will trigger a longer process and a hassle, possibly a litigation. In terms of the income tax, given the fact that in Ontario, if you don't have a will, the children are also beneficiaries, that will trigger a higher income tax burden for the estate. Beneficiaries, there is no choice. There's no choice for the testator. There's no testator because the spouse and the children are the beneficiaries according to the law. Estimated time of settlement, 24 months. This is very optimistic because I've been dealing with a case where as soon as the corporation who was supposed to be the executor was appointed by the court, a litigation started, filed by the common law spouse of the deceased. So immediately a litigation started. Likelihood of litigation, pretty high. No discussion, no advanced planning, pretty high. That gets done is litigation. And what people quite often do not realize, that an estate litigation can drag for years. I don't say years, can be 3, 5, 4 years. During that time, the estate is not settled, and there can be tens of thousands of legal fees. So the best recommendation, yes, make your will, and we are here to help in that regard.
Right. So Nicholas, just to throw some numbers at it, what's the cost of doing a will?
It will
Ballpark.
depend. I would say it will depend on the lawyer of the complexity, but I would say that generally, if there are no specific complexities, I would say between $1,000 and $1,500 for a couple. That would include the will, but also the power of attorney, which is also a key piece of the estate planning.
Right. So a small investment of $1,000 could save this family how much money and how much time?
A lot of money, a lot of time, because when there's an estate litigation, basically you end up depleting the assets of the estate from a financial standpoint. And needless to say that the family is torn apart, is destroyed. So I'm not so sure it's an outcome that anyone wishes.
Right. So you're saying that there will be little, what we call intergenerational peace of mind if you don't have a will. It's going to be a mess, right? It's going to be a mess. It's going to cost a lot of money.
It's going to be a mess. It's very likely.
Is a will a good investment, Nicholas? Final question.
For sure. It's a peace of mind for the parents, for the children, for the family, for everybody. As you said, it does ensure this intergenerational peace of mind. And it's really a small investment compared to what can be the dire consequences of not having a will.
Okay, perfect. So there is one factor that, we've just chosen a few things, and now I'm going to turn things over to Andrew Bryden, and he's going to, we talk about financial planning and wealth planning, and investment management is part of it. It's not all that's involved in wealth and financial planning. And Andrew's found an interesting study from Morningstar Vanguard that discusses, what is the, how are these factors, how do they affect overall investment returns? So Andrew, over to you.
Well, thank you, Bob. Yes, so a number of years ago now, both Morningstar and Vanguard, both global institutional firms, both individually conducted research in terms of trying to quantify the value of financial planning. And they came up with these 11 factors and quantified each factor in particular. Now, I want to be totally frank that at the same point in time, they considered these to be the financial planning factors. My personal opinion is that these are not all of the factors that comprise comprehensive financial planning, such as estate planning, time saving, peace of mind, etc., which Nicholas and Paul Nicholas has addressed, and Paul will address a bit as well. And overall, there are a few that we would like to discuss today briefly, because for the matter of time, discussing all 11 in one seminar would be too much and too overwhelming. So I'd like to touch on a few, 3 today, such as asset allocation, rebalancing. Thanks, Bob. So let's start off with asset allocation. The conventional wisdom when it comes to asset allocation is that people should own their age in bonds. So for example, if you look on the left side, there's a pie chart there. For a couple that would be age 60, for example, the conventional wisdom would be that they should be allocated 60% in fixed income, which is the red section of the pie chart, and 40% in equities. Now, in the macroeconomic environment that we're living in, I question, does it make sense that a couple that is age 70 and we're looking at financial planning for the next 30 to 40 years, does it make sense to be 60% in fixed income when a 10-year bond, for example, right now is earning less than 1%, 0.8%? I would question that very heavily. What should be considered overall is the timing of when funds are required, the risk tolerance or the personal the personal emotional aspect of volatility. For example, can someone tolerate a 10% drop in their portfolio, a 20%? Sometimes people cannot even tolerate any drop in their portfolio. Also understanding macroeconomic trends, looking at the global economy. And lastly, tax considerations. So how I personally feel is that what really makes sense is to arrange the asset allocation of portfolios in terms of buckets, which are based on goals. So what I mean by that is, by doing a financial plan, what are the funds that you require for the next 12 months, the next 3 years, the next 5 years, the next 10 years plus, and allocate certain strategies based on those goals.
Or Andrew, you could actually structure your buckets based on needs. So you could say, I need a retirement bucket. I have a major purchase. I need to save $500,000 or whatever, and then base your portfolios on those buckets. Is that what you're saying?
Exactly. Yes. So that really is a goal. So if you have a certain purpose, then that's a goal. So that should have one strategy. But if you have certain funds, for example, that you don't need for 10 years, then that's a different goal, different bucket.
Exactly.
So the next two slides are really just to give a very brief overview in terms of a bit of a next step further in terms of asset allocation and diversification, if you will. So to explain, the top line, the purple line, is the US stock market, the S&P 500. The middle line, the orange line, is the Canadian stock market. That's the TSX, or Toronto Stock Exchange. And the bottom blue line is the Canadian bond return over the last 10 years. So looking at this, it's interesting to note that from my perspective and my experience, that many Canadian investors are more heavily weighted in Canadian equities or Canadian stocks, if you will, which is really the yellow line or the orange line. Because Canadian investors are very familiar with Canadian names, such as Royal Bank, Suncor, Bombardier, etc. However, if you compare that to the purple line up top, which is the S&P 500 US stock market, has very much outperformed Canada, for example, because the macro economy in the US is very different compared to Canada. The US economy is much more diversified in terms of healthcare, technology. Canada is very much focused on energy and financials, which make up 33% of the market. At the same time, for certain buckets, fixed income or bonds do make sense. Even though they have a lower return, they are more stable. So these charts, let's focus primarily on the top two. The top one, first off, is the S&P 500 again, which is the US stock market. And the middle one is the S&P TSX, the Toronto Stock Exchange, Canadian stock market. And as you can see, if you simply start by comparing the two of them, you can see that the Canadian stock market is more volatile, because you can see more volatility, more downturns in the graphs here compared to the US stock market. And it's interesting to compare the volatility here that we're looking at compared as well at the same time with the level of returns that the US stock market has performed compared to the Canadian market. And then of course the bottom chart here shows the bond volatility, which bond volatility has been significantly higher, even compared to the US stock market. However, there's lower volatility if you compare that on the right side of these charts over the long term. So really the main purpose of these two different slides is to have an understanding of risk and volatility.
Now, Andrew, I just wanted to actually make one comment, because as I prepared this slide, we've understated the bond return. That's just price return. It's not total return. So it's somewhere up more in the 20 to 30% range, but we'll get that number for you a bit later. Sorry for that, but I thought I'd bring it to your attention. Okay.
Okay. Good note. Thank you, Bob. The next topic that I would like to discuss briefly is rebalancing. So the concept of rebalancing is, let's put this in a hypothetical perspective. For example, a family may have a current investment portfolio consisting of 60% equities or stocks and 40% fixed income, historically bonds. So let's take a, so that indicates the pie chart on the left. Now, when the stock market is doing well, stocks are going up, bonds are going down. We've been seeing that for the past 10 years, for example. Then that family's pie chart, or asset allocation, if you will, may shift to the right pie chart and may turn into an 80% equity and 20% fixed income allocation based on value, because stocks have done well. So the overall allocation has changed. So a methodical process is to rebalance the portfolio. And what that means is, by rebalancing, bringing the portfolio back to the longer term objective of a 60% equity, 40% fixed income split. So thereby selling equities and buying fixed income to come from 80-20 back down to 60% equities and 40% fixed income. And the methodical process means, if you think about it, that equities have gone up and we're now selling equities to come back down to 60%. So you're selling high and buying bonds at a lower rate. And over the longer term, very much lowering the risk of the portfolio moving forward. And this is a very methodical, important thing and aspect to consider, because when it comes to behavioral coaching that was mentioned previously, people are sometimes are very hesitant to, when they own Amazon or Shopify and the stock is going up, they don't want to sell. But methodically, it is a prudent strategy.
Right. So over time, as equities outperform bonds, that you are shifting the risk level of your portfolio if you don't rebalance. Is that a fair statement, Andrew?
That is a fair statement. So the next topic that was also addressed in the research by Morningstar and Vanguard is asset location. So once you have established what the overall asset allocation should be, or said here, what your pie chart should be, then the next step is to determine where and what assets should be in what type of accounts. So for example, most people have their RSP or the RIF accounts, which are registered. They have their non-registered accounts. You have your tax-free savings account. And we've summarized here that the just to recap that registered accounts such as RSPs and tax-free accounts, the investment income is non-taxable. However, with a non-registered account, all income is taxable. So when it comes to asset location, the key is that you can have the same pie chart, but be more tax prudent and have strategies in terms of looking down below. Bottom right here, we summarize what we talked about a month ago, that other income or salary and interest is taxed higher than capital gains and dividends. So to be more strategic, why not have your securities that earn interest income in your registered accounts, such as RSPs, RIFs, or a tax-free savings account, and have your equity allocation or your stock allocation, which earns capital gains and dividends, and have it more focused into the non-registered accounts. So the overall idea is to have this, we already looked high level, but now let's minimize taxes as much as possible.
Right. So that is by saving taxes, that can have, to quote a TV commercial, it could be life changing, right? By optimizing the tax situation in your account. So just for sake of time, just a quick one. Question, will I run out of money? Is that, just speak for a quick minute on that particular item.
Certainly. So this is one of the most often asked questions from people in terms of, do they have enough? And I have many case studies that I can speak to, but I'll keep it very brief. For example, I've had a lady that I met 6 years ago that I've been working with. She had $4.8 million. And she was shopping at Food Basics, Value Village, but she was so concerned about whether she would have enough to live off of. And she also owned her home. I have met people where they did not enjoy their job. And overall, long story short, in doing a proper financial plan, gave them peace of mind that the lady that was 78, I told her, go to Longos, stop going to Value Village, go to the Bay. You are completely fine. Other situations, it was from doing a financial plan, able to tell people that they could quit their job tomorrow. And those were some of the most meaningful meetings that I've ever had in my career. Just seeing their reaction, that they felt completely comfortable, and you could just tell immediately that their life changed. So to this, I would just say how important having a proper financial plan is. Yep.
And that's a good segue over to Paul Tyers. And the next slide is what is comprehensive wealth planning. And actually, I think we're just going to skip because we've covered some of that already, Paul. But just for the sake of time, let's talk family harmony and what we call intergenerational peace of mind.
Well, first, I just wanted to thank Nicholas and Andrew, because there certainly are technical aspects to financial planning. And then I think Andrew was able to spell out from really quantifying the value of planning. But I have to tell you, in my 33 years now in the financial planning business, nothing compares to the peace of mind that Andrew spoke of. And increasingly, we're seeing issues that relate to intergenerational issues. If you don't mind, Bob, I'm just going to tell a quick story that happened to me in the last month. I was introduced to a lady, we'll call her Barbara. She was introduced by her CPA, and it came about, her husband had passed away, a number of years ago, probably 5 years ago. And the reality is this is a very affluent family. They had a nice home, they had real estate, and actually there was still a remnants of a business. Well, you can imagine that the husband in this case had been really the chief financial officer of that family in that instance. And now I get introduced to the widow. And the first day I met her, we're sitting at a dining room table, and there was literally boxes and binders and so on. And she wanted to be ready for the meeting. And I could tell you just the level of fear there was in even entering into that discussion, because some of the terminology that we use, that was used a little earlier on, can be very, very overwhelming. And then we started to look at, some of the assets and liabilities, and even some of that. What's a liability? What's an asset? And we were able to literally take those boxes and binders and make some sense out of them in the first day. One of the biggest issues was she wanted to be equitable, fair to her children. And I would say, as a parent and grandparent myself, family harmony is probably one of the most important, some will call it intangible, I call it very tangible, outcomes. And if that can be enhanced through financial planning, that's ideal. Well, in this instance, she wanted to be very certain that she was equitable or fair. She used the word equal, but the reality is equal is not necessarily equitable, because in that case, there were several children. Not everybody had financial acuity. Some, quite frankly, had some bad habits. And but she wanted to be at least equitable. And at the end of the day, she wanted everybody to get along. Well, that led from binders to actually us putting together, and we put it on about three pages, and got back with a report, tried our best to not use financial and tax and legal terminology. And we were able to get back to her with this. And then we got talking about executors. And she had already described the fact that there had been some, like a lot of families, not everybody gets along all the time, and really wanted to make sure that that family harmony was preserved. And we got talking about the concept of being an agent to the executors, a term she had never heard of before. And what I described it as really the person who does all the technical work, and at the end of the day presents options so that people will be able to view the options without having been entrenched in a particular concept or idea, the lightning rod. And by the end of that second meeting, what she kept coming back to is the most important part of the meeting wasn't the assets and liabilities. And she did learn that she would never have to be concerned about finances again, but was the fact that there would be family harmony in a greater likelihood. So I'm not going to go through some of the things, the wording on this slide, because they're things that Andrew and so have talked about. Is there going to be enough? The state matters. But the reality is I want to emphasize that family harmony. And increasingly we're seeing that in not just mom and dad and children, but into grandchildren and if there is considerable wealth. The next slide will tell us how we go about that. But before we do, what's the value of that family harmony? Priceless. Next slide, Bob. So I want to spend a little bit of time here at a high level. And this is a document that we try to take down to one page wherever we can. And on the left-hand side, not the blue, but the left-hand white side, you can see vision for the family and wealth. And usually that is with the people who actually generated the wealth. But typically they have ideas of what they'd like the wealth to do for them for more than just their own lifetime. The next category is preferences, is how often would you like to have a discussion with somebody about your wealth planning? And we sort of default to quarterly meetings, but I can tell you that some people don't want to meet that often, or they want to meet when they have a particular need, and that's understandable. The next on the left is current goals and priorities. So what we try to do is to say, rather than put the whole shopping list of what needs to be done in the areas of tax and estate and investing and retirement and so on, try to break it down into things that can be accomplished in the next 12 months. Okay. And then in the middle column, you can see that this is the net worth of this individual, and it's the net worth when they happen to join our firm in 2018. And below that, we put down some of the things that have really been accomplished. You can almost tick the box. They've been taken care of from the day they came in. And then you can see at the top right, this is the overall wealth situation about 18 months after, or 2 years after they were met, okay? And some of that improvement is not just in the portfolio, it's in the value of property, it's in the value of a business, and it may be in the value of a portfolio. And on the right-hand side, what we try to do is to take those meeting times and to break it into what's called a wealth management roadmap. And it's just some of the specific dates where meetings will be held and what will be addressed. And on the bottom right-hand corner is, here are the people that are going to collaborate. And I can tell you, when it comes to comprehensive financial planning, it's essential that professionals from different backgrounds not only know one another, but share information, and really so they're singing off the same song sheet. So this is how we go about it. Some of these processes have literally just been implemented in the past year with some new software, but I can tell people overall that this is the value that people get. Some's tangible, somewhat's intangible, and these are some of the tools and the ways we go about it.
Right. So Paul, if I look at this document, this looks less like wealth management or financial planning and more like project management. Is that to my favorite question, I guess, today? Is that a fair question?
I think that's a great observation. Yeah, I think that's a great observation, because you won't see many numbers in here. You see two numbers. Now, in behind here, as Andrew alluded to and Nicholas alluded to, there may be a fair bit of number crunching going on, but none of us, including myself, can sort of keep track of all the numbers. This is really a summary document of where we've been and where we're going.
Right. And if you always know the answer to three questions: where am I today? Where do I plan to be in the future? And how do I plan to get there? That removes a lot of stress from your life. So
Absolutely.
Anyway, that's, those are that is what we have had for on our agenda today. We often don't get many questions when we do this. We liked them. It looks like if I click the Q&A button, that we see some of them. So do you really believe that there are bad days ahead? Is a question. These are, I think, mostly the ones at the beginning. Do you believe there's bad days, or at least ever going to win the Stanley Cup? And how do items 1 and 8 differ? So that was a question. The others were just the ones that I prompted at the beginning. So let me just go back to that slide there, number 1 and number 8. So asset, the question therefore, I think, Andrew, is what's the difference between suitable asset allocation and asset location?
Well, that's a great question, because there's only 2 letters that differentiate, but the concepts are very different. So asset allocation is how much an overall portfolio is invested in equities or stocks compared to fixed income, such as bonds. That's the high level for asset allocation. For asset location, once you do have your portfolio allocated in terms of how much you have in equities and bonds, then asset location is where do you locate the equities and bonds in terms of what types of accounts from a tax perspective.
Yep. Okay. Yeah. Thanks
So
for
if I
that.
can clarify that any further, I'm certainly glad to.
Uh-huh.
Bob, I wonder
Okay.
if I could just make a comment. And let's face it, given COVID and the government deficits that are being run, I think it is very logical that tax rates will go up. We don't know when, we don't know where, but quite likely they will go up. And I believe this point that Andrew was focused on will become increasingly important. And I say to people, be proactive. Don't wait. There are some location things that can be set up. In some cases, it's a trust, it might be a corporation, or it might be things like Andrew has pointed out in an RSP, TFSA, et cetera.
Mm-hmm. Okay. I just also wanted to throw out a couple things. Number one, without using any last names, I want to say thanks to Robert. He's been I think, Robert, you've been on almost every call that we've done, and you've been upfront with many questions. So we appreciate you joining. And also, I want to just say hi to Brian, who I had a good conversation with Haley recently, and I'm so glad that you were able to join the call today. And Jim is saying, respecting saving, in what order should I focus my efforts? Education, retirement, taking care of the kids. How would you, anybody on the panel wish to take that one on? So, if you were to try to take education or retirement, taking care of the kids, that sort of thing, how do you rank them?
I can certainly address that, Bob.
Mm-hmm.
The simple answer is that it depends. Depends on your marginal tax rate. You also want to maximize, first and foremost, RESPs, because that the grants from the government are 20% of what you contribute per year. So maximize that. But it really comes down to overall tax planning. I don't mean to dodge the question, but the answer comes down to it depends on the tax situation.
Yep.
Bob, when I hear that question, I think of a different angle entirely. And I think of the book in Canada that was so well known called The Wealthy Barber. Many will have read that book. And when it comes to saving, yes, it matters where you put it, but the point is put your money aside first. And once you've done your saving, then live off the rest. And it's amazing that principle, if done over a lifetime, people won't have any financial problems.
Right. And I just flipped back to the slide that shows the roadmap and such. And that's how I would answer the question, is that, it really, that it comes down to preferences and priorities. One of the things that Peggy Tires had done was a series of blocks that you could lay it on a table and ask somebody, just move these blocks in the order that you believe are your priorities, and walk out of the room, leave the person to think, and just have them sort it out. But it really comes down to every single investor, every single person who involves themselves in wealth planning, they have their own priorities. In some cases, there might be something where, they've been worried that they haven't had a will updated in 35 years. And that's one of the priorities, so that, when you go through what we call the preferences and priorities survey, it just helps you to identify what is most important to you. It doesn't matter to us. It doesn't matter to us. If you think that something's more important, let's do it. Let's get it done. It is more identifying what your preferences are, identifying your priorities, building a plan, as we have done in the third column here. And, you know, as I like to phrase this, you know, and I come more from, well, you know, I've been in the industry for 40 years, but last 20 something years, I've been working as a coach to some of North America's top financial advisors. And, you know, it really, really comes down to, if it isn't important enough to book time for, it's not important enough to do. And often as clients that you look and you may have a question, you say, am I ever going to hear from this advisor again now that they have my money? And really you should have that project plan that says in March, we're going to get together. Maybe it's March 14th that we're going to get together, but March 13th, the COVID hits and you can't do it and you have to figure out a better way to do it. But setting a time aside to make sure that it gets done. And if it doesn't happen on March 13th, but it happens on March 21st, that's okay. We got the work done. We set the time aside. And another side is that you want it to be in bite-sized pieces. Wealth planning is overwhelming. And if you had one meeting, you tried to do a tax and estate and investment and everything in one meeting, that's too tough. Spread it over time. Understand the different components and feel comfortable with it before you move on. But thank you to Jim for that question. And, you know, you know, it's an interesting topic. When we talked about delivering this, the idea is that we've never, other than the Morningstar survey that we showed you, not many people really talk about quantifying, you know, if I invest $1,000 to get a will done, what might the payback be? And that's what we really try to help you to understand through the process. So thanks to everyone for joining us today. And we appreciate all the questions today. And we hope that the weather clears up. It's supposed to be nice on the weekend. And we hope that you all have a great weekend. So thanks. And we'll talk to you soon.